Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. Today I'm joined by a special guest, Brian Davis. Brian's a real estate investor, personal finance writer, and co-founder of SparkRental, a passive real estate investment club. He has over 2 decades of experience in the real estate and financial services industries. Currently, he owns interest in over 2,000 units, adding more each month in a form of dollar cost averaging. In addition to hosting the Live Off Rents podcast, Brian regularly contributes as a real estate and personal finance expert for Bigger Pockets, Iman, Best Ever Real Estate, RE Tipster, and more. Along with his wife and daughter, he spends most of the year overseas living by his own rules. He loves hiking, cooking, pairing wine with said cooking, scuba diving, and occasionally surfing. Most of all, he loves showing others how they can create their ideal lives through real estate investing and lifestyle design. Brian, welcome to the show.
Marc, thank you so much for having me.
Before we get into it, what's your favorite type of food to cook?
Well, I'm going to be really boring here and say steaks because
No, it can't beat steak.
My wife loves steak. We love red wine, and nothing pairs better with red wine than steak. Sorry, vegetarians. I'm going to be boring. I'm going to say a coffee encrusted steak is probably my favorite dish to cook. It's my go-to, on a random Friday night with my wife. But I love everything. Asian food, Indian food, pasta and Italian, you name it. I love it.
Can't beat good food. So let's actually get into the topic of real estate investing. And I know you started your career as a hard money lender. So you got to see kind of how real estate investing, it can build wealth, it can build passive income. How did you transition from that to, really, I guess, getting involved on the investment side of things, which is a little bit different flavor of real estate investing than hard money lending?
Yeah. So, I didn't know anything about real estate or lending or finance or anything. I graduated college with a degree in psychology and a degree in criminal justice. And I had no idea what I wanted to do with my life. So, my parents were kind enough to introduce me around to all their friends and, ask if they would give me an informational interview. And a friend of my stepdad's, he was a partner at a subprime mortgage lending company at the time, which, back in 2003, that was cool, right? That was all the rage.
Yeah, place to be.
Yeah. History has not been kind to subprime mortgage lending. Anyway, that guy and his partner, the other guy who owned that company, on the side of that company, they did hard money loans. And so they offered me an internship for the summer after I graduated, and I worked with them. And at the end of the summer, they said, hey, we don't need another loan officer. We've got dozens of loan officers doing subprime mortgage loans, but we do need someone to help us with our hard money loans. And they asked me to stay on permanently, working with them as basically an account executive for hard money loans or loan officer. So I started working with investors. Real estate investors were the borrowers who I was working with day in and day out. Back in the mid-aughts, everybody was making money in real estate, right? It was a big party in real estate. So I'm watching all these guys just make money hand over fist, doing flips, doing BRRRR deals. And I sat there and thought, I'm just as smart as these guys. I'm smarter than these guys. I can do this too. I'm going to go out and I'm going to buy rental properties, and then I'm going to have enough rental income that I don't have to work anymore. So I promptly ran out and I bought a bunch of properties, having zero clue what I was doing, and just lost a boatload of money when 2008 came along. And I made every mistake you could possibly make. I chalk it up to the arrogance of youth. I didn't go out and get mentors or coaches or learn what I was doing, and I paid for it. Yeah, I was going to say that's a short version, but it actually wasn't that short.
So I guess you had your expensive lesson in real estate investing, and what would you do next in the real estate investing field? Did you go and get some education, some knowledge, or did you change paths and eventually came back to it, or did you kind of take a different approach to it?
Yeah, a bit of all of the above. I became an expert in rental investing, but I did it the hard way, having to make every single mistake myself instead of learning from other people's mistakes. But when 2008 came along, what was really hard for me is that not only did my investments just completely collapse, but my day job also pretty much disappeared overnight because no one was borrowing hard money loans anymore. So I had to go out and I had to get a new job, new career. I started working for an e-commerce company that serviced landlords. But, the silver lining with all that is the only reason I got that job is because I was a landlord. So I never would have gotten that job if I hadn't had those direct experiences investing in real estate. I entered the online business space, and I've been in that ever since. So that was sort of one turning point for me. Another turning point, my wife and I moved overseas in 2015, and I still had, 15 rental properties at the time. And when we moved overseas, we moved to Abu Dhabi, I realized just how much I had been subsidizing those properties' returns with my own labor. So, I had been the one, spending weekends messing around with these properties and with contractors and with tenants and, chasing people down and nagging people, basically. I just felt like the nagger in chief, like you're trying to stay on top of, all these people who weren't doing what they said they were going to do. That's tenants, that's property managers, that's contractors. Everybody says they're going to do something and then they don't do it. I realized that with the very meager and modest returns that I was earning from some of those early properties that I bought, it was actually worse than that in reality. Those meager returns on paper were actually really negative if you took into account my labor and the time I was putting into those properties, which of course you don't have in a purely passive investment like buying an index fund or investing in a real estate syndication or a real estate crowdfunding investment. Purely passive investments, you don't have any of that labor, and you have to take that labor into account. It's very real. Anyway, I ended up getting rid of all of my rental properties while being overseas. And I still loved real estate. We taught real estate investing, and we still teach real estate investing at SparkRental. So I was feeling out of integrity about that, the fact that I'm teaching something that I wasn't actually doing anymore. So I got into passive real estate investing, or rather started exploring passive real estate investing. So I dabbled in a whole bunch of different real estate crowdfunding websites to, experiment and get firsthand experience with some of those. I started investing in real estate syndications to get experience with those. And it was around this time that, a lot of our students, we sold courses and, we work with a wide audience of real estate investors. So our course students and some of our other audience members had been asking my partner and me, I've got some money to invest. I'm not ready to go out and buy a property by myself. Can I just partner with you guys on a deal or can I invest with you guys on whatever you're investing with? And we kept saying no to all those people. Again, this is around that time where, feeling kind of out of alignment about all that. And I turned to my partner one day and I said, hey, what would it look like if we actually said yes to that? So we started experimenting with co-investing projects. We brought in some of our students on a couple single-family deals with a local partner, a guy in Michigan, a boots-on-the-ground kind of guy. And that was fine. We came out with perfectly good returns, but it was way too much work. So we went back to the drawing board, and then we experimented with a real estate syndication as a joint investment. And it was a hit. And it's a totally passive investment, right? That gave birth to our current focus, which is our co-investing club, where we go out on these deals every month with all of our club members, and people can go in with small amounts on those. And it's fun. We get to approach this as a community, as a club.
We're going to expand on that, but I want to go back to two things that you mentioned. So one is that when you had these direct ownership in the properties, one thing you hit upon that I think is really true is that it's real estate. And even though it looks and smells like it's going to be passive income, it really isn't. There's work involved. Even if someone will say, okay, I'm going to put a property manager in place, and you can have the world's greatest property manager, and there's a wide range of property managers that are below that. You're still going to be following up with the property manager and having to make decisions and do things. So when you have direct ownership, it's more of like a business. You're a business owner.
It's a side hustle.
Is what it is. And the other thing I think that mentioned that also makes sense is you were kind of saying I was making these meager returns. A lot of people that I know that invest in real estate, they'll look at the rental income that comes in, and they'll say, okay, I have $1,000 coming in a month, and my loan is going to be $900, and therefore my net is $100. And in reality, there's a lot more that goes into that calculation of income and expenses, whether they don't take vacancy, repairs, it's like a long list of things that you truly have to. And yeah, real estate is definitely, and direct ownership is a great way to amass wealth, but you just have to kind of look at it through the correct lens of what you're getting into. just, so that you have those expectations going into it.
Yeah. So when I first started investing in rental properties, I still thought that a property's cash flow was the rent minus the mortgage. And oh my God, was I wrong? I mean, and it took me a long time to figure that out. And that was one of those things that if I had just gone out and gotten a mentor or a coach or even a senior partner, I could have skipped all those headaches. So in the industry, one of the shorthand that we tell people just to get them thinking in the right direction is the 50% rule, that on average, about 50% of the rent is going to go towards non-mortgage expenses. So those include things like vacancy rate, repairs, maintenance, property taxes, insurance, accounting and bookkeeping, property management costs. So when people first hear that, their initial reaction is, well, then how can I ever find a property that's going to cash flow right? And I say, exactly, like that's the point. It's hard to find good deals. It's hard to find properties that cash flow well. There's not just a deal tree that you go and pick deals off of, right? So, there's work to invest in in the first place to buy a good property. And then, as you pointed out, there is work in owning it over time. So it's not passive investing, nor is it passive income. It's active investing with semi-passive income, but it's a side hustle.
Yeah. All right, let's transition over to SparkRental and how the investment club actually works. So I know you mentioned was it monthly? And what do you do? Are you pooling money together each month, and then based off of what that pool looks like, you're finding something, or is it finding something first and then figuring out the pool?
Yeah, so our attorney tells us we're not supposed to use the word pool.
Okay.
but yeah, so no, we are not syndicators ourselves. We're not a fund of funds. We're not selling securities. We don't get any money. We don't get a cut of the money that's invested. Instead, we follow a flat fee investment club model. We just charge a flat membership fee to be a part of our investment club. And every month we are getting together to vet deals together as a club, as an investment club. So you can think of like an old school stock investment club where, people get together and they sip brandy or whatever and puff on a cigar and they talk about stocks, and then they go in on some of those stock investments together. It's like that, but with passive real estate investments instead of stocks. So we will bring in a syndicator to speak with the club. We aim for once a month. These deals are opportunistic, right? It just depends on when deals come along that we think are a good fit. So it might be none in a month. It might be 2 in a month. But we aim for 12 a year and an average of 1 a month. So we'll bring in the syndicator, the sponsor, to present the deal basically to our members. We'll grill them together as a club, which, by the way, is awesome because every time people are coming up with questions that never would have occurred to me, right? And that's the beauty of vetting these together and having almost like a hive mind where we all get the benefit of each other's expertise and different ways of looking at these investments. And then whoever wants to participate in that investment can do so with relatively small amounts. The minimum is $5,000 per person, whoever wants to invest in that particular deal. And that might not sound like chump change. That might sound like a significant amount of money, and in many ways it is. It's a lot less than the typical $50,000 or $100,000 minimum that is required by private equity real estate syndications. That's part of the challenge with investing in passive real estate syndications is the high minimum investment, is finding good sponsors and vetting them and networking with them. And especially as non-accredited investors, the rules from the SEC are that syndicators cannot publicly advertise these investments if they are available to non-accredited investors. So that's kind of a catch-22, right? If you're not an accredited investor, how do you find people who are offering deals that you can participate in when they can't advertise to you? That's part of what we're doing is we are doing the networking on behalf of our club members, bringing in the sponsors, and then we all vet these deals together.
So if an investor isn't interested in the deal, the minimum investment is $5,000? That's
exactly how it works. Yeah, and anyone who wants to participate in the deal can do so with $5,000 or more. Together, collectively, we'll be passing that $50,000 or $100,000 minimum. So, so we were able to invest under a single entity. We created a joint LLC for each one of these deals, and there's no pressure. No one has to invest in any of these deals. Part of our mission really is diversification and is bringing in lots of different types of deals, different types of properties, different cities and states, different syndicators. So not every deal is going to be a good fit for every person, right? Some people are more interested in cash flow and income, passive income. Some people are more interested in growth and profits and that big paycheck at the end, and that's fine. that's okay. Some people want the shorter term investments. Some people are happy with the longer term investments, as long as they earn a high return. So, that's all fine. Not every investment is going to be a perfect fit for every club member. So, yeah, whoever wants to participate can do so. And if not, there's going to be another deal in a few weeks, right?
Can you discuss some of the risks with these types of projects?
I can't remember who wrote this book, but there's a book called The Road Less Stupid, and they're talking about investors and real estate investors in particular, and how novice investors, they enter these through the lens of how much can I make, and more seasoned investors, look at these through the lens of how much can I lose on this investment. And that's the lens through which we try to look at these, is focusing on risk first and foremost. How is the sponsor addressing all of the different risks that we think are present, for this deal in this market? And that the elephant in the room there is debt risk, right? The longer term the debt, the safer. If it's a fixed interest debt, that's better as well, right? And I'll give you a really quick example. There was in 1 month last year, we were looking at a deal that we did not end up investing in, largely because we didn't like that it had short-term bridge debt. It was 2 years or 3 years bridge loan debt, and we're sitting there thinking, I don't know what the market's going to look like in 2 or 3 years. It might not be a good time for refinancing or for selling, right? We ended up investing in a deal where the sponsor, they were buying a portfolio of 2 hotels, and they were assuming fixed interest loan at 5.1% interest with 9 years remaining on it. And from there, the conversation was, well, sure, I don't know that within the next 2 or 3 years there will be a good time for selling, but at some point within the next 9 years, there will probably be a good time to sell these hotels, right? So you have that flexibility, and so it's a low fixed interest rate. You got 9 years remaining on it, plenty of runway, plenty of time for the market to work itself out. So debt risk, that's one area of risk. Property management risk is another one. We like to invest with sponsors who ideally handle their property management in-house and have a very deep track record of doing so well. Or if not, then they have a partnership with a local property management firm who they also have a deep track record of success with, right? So property management risk is another one. There's political risk. We try not to invest in any areas with anti-landlord laws, super heavily tenant-friendly laws, because the next time there's any kind of crisis, they're going to be the first people who put in another eviction moratorium, for example, right? Now, that doesn't mean we will never invest in those markets. So, for example, we've done a couple deals in Southern California, very tenant-friendly market, but one of the deals we did there, it was vacation rentals in an unincorporated township up in the mountains. So, you didn't have to worry about residential regulation. It was short-term rental stuff. And likewise, sometimes we'll invest in retail or industrial in areas that have, bad residential laws, but those don't apply to, these commercial properties. So, so political risk, property management risk, there's construction risk. Who's doing the repairs? And again, is it in-house? And if so, has the syndicator done a lot of these types of deals before in this city? Do they have the same team of contractors going in and working on these properties? Or are they bouncing around to a bunch of different markets and just hiring subcontractors or hiring contracting teams? That adds to the risk, right? So, the list goes on, but the point is you have these buckets of risk, and you want to look at every single deal through those lenses. How are they managing all of these different types of risk? And how comfortable do I feel with how they're mitigating these risks?
How do you gauge the success of working with a specific sponsor or syndicator? I'm sure there are specific attributes you want to see, like when you're bringing them into the club to work with your members. Is there something you do to make sure they're a good fit?
We have an informal rule, but we really try to follow it, and that's that we don't invest with the same sponsor within a year of doing our first deal with them. So it's like a 1 year probation period, basically, for sponsors. We have not always followed that rule. I wish we had. But yeah, you want to see, what's their communication style? How do they handle hiccups as they come along? Because that's how you can kind of separate the wheat from the chaff, right? With these sponsors. So we do try to follow that rule. and the club is getting to the age now where we do feel more comfortable circling back to some of those sponsors who we did invest more than a year ago with, and looking at some of their new deals. And then we have more confidence going in and doing a second, third, fourth investment with that sponsor because we have direct experience with them, and we can say, this has been our experience with this sponsor, a direct firsthand experience with them. So we feel better about investing more money with them in a new deal.
Can you explain how the ownership is structured as well as the process of tax reporting? What does that look like?
Yeah, so we approach these as joint venture LLCs. So each participant in a given deal gets listed as an owner of the LLC, proportionate to their investment amount. And they're an owner. The LLC itself will get a K1 at the end of each year. And then, we have to have an accountant come in and divvy up those K1s for each individual person. It does add a little bit of expense for these, but that's the cost of of going in as a small dollar investor in these kinds of private equity deals, right?
Considering the market climate and the lessons learned from previous deals, what's your target for the number of deals that the club offers to its members? And then also, how do you assess which opportunities are worth investing in?
We aim for 12 deals a year. We did 13 in 2023. So it's been a turbulent market in commercial real estate for the last 2 years, no question. And some of the earliest deals that we did, a couple of them are a little hairy. I'm not gonna lie. In retrospect, that was not an ideal time in the market cycle for investing. But what we have found is that both sponsors and limited partners, passive investors like us, everyone got a lot more conservative over the course of 2023 for the better. So, late 2022, very early 2023, some of those deals were still not being conservatively underwritten. The underwriting that we see today is a lot more conservative, and I think that it's not a bad time to invest right now. I think there's a lot of bad headlines in the news because of some of those deals from 2021, 2022 that have really struggled and in many cases have lost money. But when there's bad headlines, that is not necessarily a bad time to invest, right? I can't remember who it was that said invest when there's blood in the streets. But so there are always deals available. And I think if we had known in 2022, if we had the skill at analyzing these deals that we do today, I think we would have probably been able to avoid, one or two of the underperforming deals that we did invest in at that point. But part of our philosophy with this club is just that you're going to have, you're going to split small amounts of money across a lot of different deals instead of putting a lot of money into a couple deals. So at the end of the year, you're going to have maybe one or two that underperform, you're going to have one or two that overperform, and then most of them will just form a bell curve, right? So at the end of the year, it's not sitting around and chewing on your fingernails, worrying about how that one investment that you put $100,000 into, how that's doing. It's just an average of numbers on a page of, these 12 deals that I invested in, how do they all add up, right? And it's a much lower stress way of investing.
What type of timelines are these investments typically? Are they all long-term, or do you ever consider bringing in short-term opportunities to the club?
Yeah, it's a mix. So we were looking at a deal this morning, actually, that is a short-term deal, less than a year is the deal. And then we've invested in deals that are planned for perpetuity, basically, where the idea is to stabilize the cash flow and add value and then refinance to return everybody's initial investment. But, we as LPs, as passive investors in these deals, we keep our ownership interest in the property and keep collecting cash flow indefinitely on it, even though we've already gotten our initial investment back. So, what they call infinite returns. So it just depends. Some of these are short-term deals. We invested a couple months ago in a secured note that is just a floating 6-month note. So people can cash out anytime, basically, with 6 months notice. So it's basically a 6-month investment that just, rolls over every single month. And then, we've invested in deals that we might still be collecting cash flow on it in 15 years from now. So it just depends. Like we talked about a few minutes ago, that's part of what we're aiming for is that diversity of deals.
All right, Brian, that's all the questions I have for you today. Thank you for joining me. Where can listeners go if they want to learn more about you and what you do?
Yeah, so SparkRental.com. You'll see our co-investing club front and center there. You can reach out to us at support@SparkRental.com. You can reach out to me personally at Brian@SparkRental.com. Hit us up on any of the social platforms. We're pretty active there. We've got a Facebook group with around 50,000 real estate investors in it. Another for beginners with 7,000 or 8,000. There are many ways to connect with us. We would love to hear from you. We are very much a mom and pop company, we'd love to just chat with people and hear what they're looking to do with real estate.
Great. We'll include all that in the resources section of the show notes. Thanks again, Brian, and thank you to everyone who tuned in today's show. Don't forget to follow the Agent of Wealth on the platform you listen from and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.